Thank you, Mr. Running. And now recognize Mr. Jack Roney, Director of Economics and Policy Analysis, American Sugar Alliance. You're recognized for 5 minutes.
Thank you, Mr. Chairman and Mr. Nolan, members of the committee. I'm Jack Roney, economist with the American Sugar Alliance. The ASA is the national coalition of sugar beet and sugarcane growers, processors, and refiners. The U.S. sugar-producing industry generates 142,000 jobs in 22 states and $20 billion per year in economic activity. I would like to summarize my written testimony today by describing why we have a sugar policy and how it's working. The U.S. is the world's 5th largest sugar producer and among the world's most efficient. If we are so efficient, then why do we need a U.S. sugar policy? The answer is in the tremendous distortion in the so-called world sugar market. This chart tracks the world average costs of producing sugar over the past 3 decades. The cost has averaged 19 cents per pound over those years. If I added the world average sugar prices to this chart, what would you expect? Certainly, we would expect prices to average above the cost of production, high enough to keep producers in business. But here's the reality. The so-called world price, the red line, has averaged just 13 cents, almost always well below production costs. The 28-year average production cost is nearly 50% higher than the average price. With prices so far below cost, how can any sugar producer survive? The answer is in the domestic markets where most sugar is produced and sold. Governments maintain much higher prices than the world price so that their farmers can stay in business. Only about a quarter of sugar is sold at the world dump price. The remaining 3/4 is sold at much higher levels in the countries where the sugar is produced. Foreign governments subsidize their producers so generously they tend to overproduce. To bolster prices in their domestic markets, these governments export their surpluses. That shifts their domestic surplus problem onto the world market. Absent subsidies for inefficient foreign producers, the world price would rise to reflect the cost of producing sugar. That is why we support the resolution introduced recently by Congressman Yoho of the Ag Committee. This zero-for-zero approach says that the U.S. will eliminate its sugar policy when foreign countries eliminate theirs. We are ready, willing, and able to compete on a level playing field free of government intervention. But to give up U.S. sugar policy without any concessions from foreign subsidizers would be economic suicide for American sugar farmers. Unilateral disarmament is the antithesis of free trade, sending good American jobs to countries still subsidizing. American sugar policy is working well for American consumers and taxpayers. American consumers' prices for sugar are among the lowest in the world, the red bar on this chart. Global average retail sugar prices, the green bar, are 20% higher than U.S. prices. Developed country retail prices, the yellow bar, are almost 30% higher than U.S. prices. American consumers get a great deal on sugar that is high quality, safe, reliable, and responsibly produced. American taxpayers get a great deal too. As instructed by Congress, U.S. sugar policy has run at zero cost to taxpayers for 14 of the past 15 years and is projected to remain zero cost. The only exception was 2013, when massive volumes of subsidized dumped sugar from Mexico depressed our market and made it impossible for some producers to repay their operating loans. USDA projects zero cost for sugar policy over the next 10 years. The CBO projects some possible cost several years from now, but this is based on the assumption that Mexico is allowed to resume dumping. Mexican dumping poses the greatest challenge to sustaining a no-cost sugar policy. After Mexico's dumping in 2013, the USITC unanimously found that Mexico had injured the U.S. industry. The Department of Commerce calculated subsidy and dumping margins that totaled more than 80%. Rather than imposing those huge duties, the Mexican and U.S. governments negotiated suspension agreements in late 2014. These were intended to allow continued sugar trade without Mexican dumping. But the suspension agreements have not been successful, and American producers are still hurting. The two governments are negotiating improvements. We support these efforts, but if they are not successful, we support the imposition of duties on subsidized dumped Mexican sugar. American sugar producers have had to endure flat pricing for their sugar for most of the past 3 decades. In real terms, corrected for inflation, prices are down 43% since 1985. We have lost more than half of our beet and cane mills, 57 closures in all. The most recent casualties, Mexican dumping has driven Hawaii out of sugarcane after nearly 2 centuries of high-yielding production, and a Wyoming beet mill will close permanently later this year. The remaining sugar producers will have a chance to survive only if, 1, U.S. can implement an adequate response to Mexican dumping, and 2, the next Farm Bill contains a sugar policy that provides a strong economic safety net. Thank you for your attention and your support for American sugar beet and sugarcane farmers.
Thank you. I'd like to thank